Hello everyone, my name is OJANGOLE Andrew. I'm going to take you through the global economic crisis. Under the global economic crisis, we are going to talk about the global financial crisis of 2007 to 8, and we are also going to talk about the Asian financial crisis of the late 1990s. The global economic crisis refers to the period of extreme global economic stress faced by markets and consumers. Economic crisis results to fall in the real per capita income. It also results in increased levels of poverty. So if there is a fall in the real per capita income, it also means people will be poor because they will not have money in their hands. So it hardens the business success. Uh, if people don't have incomes, they are poor, it means their purchasing power is low. So that means businesses have to face challenges because the level of demand in an economy is reduced. Higher levels of unemployment. So at the end of the day, if there if there is if the businesses are facing hardships in an economy, it means most likely some of them will collapse, and if they collapse, it means all their employees will have to go home. And if there are those which remain in the business, it means they will have to cut or reduce output to meet the level of the demand in an economy. So this translates into reducing the number of workers because you can't keep everyone when the output is going to reduce. So at the end of the day, we are saying this crisis is related to unemployment in an economy. So what are the possible causes of economic crisis? The possible causes of economic crisis include high levels of unemployment, higher interest rates, tight lending policies, decrease in consumer spending, wars and pandemics. Higher levels of unemployment simply mean if there is a low level of demand in an economy, if farms are facing hardships, it means people will be unemployed. And when people are unemployed, it means they will not have income to spend. If they are not having income to spend, it means the consumption is going to be low. And if the consumption is low, it means business is still going to face a crisis of low demand. And if there's low demand, it means businesses will face hardships to exist at the end of the day. It ends up with what we call economic crisis. High interest rates. Uh, when there are higher interest rates in an economy, say for example, if bank lending rates are high, it means consumers are unable to access loans to enhance their purchases. Businesses cannot access these loans easily to finance their growth. So this means there are likely going to be a challenge in an economy whereby there is low demand, and the low demand means firms have to cut output, and if they cut output, it means there is going to be unemployment as some workers are laid off, and if some workers are laid off, it means that even worsens the the incomes of individuals. So when the incomes are reduced further, it means the purchases also reduce further. At the end of the day, it means businesses will have to go out of the market. Uh, Tight lending policies, and of course, uh, if policies of lending are tight, maybe banks are following stringent measures to give out money to individuals and businesses, it means the borrowing is discouraged. If borrowing is discouraged, it means consumers are unable to access money that will enhance their purchasing power. Businesses cannot get money. It means there will be low levels of savings in an economy. If there are low levels of savings, it means there will be low levels of investment. So at the end of the day, this affects the economy negatively, leading to economic crisis. A decrease in consumer spending. So we are saying if there is unemployment, if which reduces people's income, and there are higher interest rates. That means people cannot borrow. There are tight lending policies still regulating people from borrowing. It means the consumer purchase power will have to go low because people don't have money in their hands. The the incomes are low. So at the end of the day, the consumer spending goes down. And if the consumer spending goes down, it means the businesses in an economy have to suffer. And if they suffer, it means some of them will collapse. And if they don't collapse, they will have to cut output. And if they cut output, it means there's still more unemployment. And if there's still more unemployment, so at the end of the day, this all contributes to what we call economic crisis. Wars and pandemics of recent we have heard of the Russia-Ukraine war, which has affected many economies. Most of the economies, most of the countries were relying on the oil from Russia, the oil imports from Russia. So at the end of the day, when this wars came into the equation, things became tough. It means Russia cut uh, its exports, oil exports to some countries, and that translated into higher prices of fuel. And when price of fuel went high, it means the production in in most economies, the production costs in most economies went up. And when they went up, it means the prices of the general price levels went up, and that means this also affected the demand. And when the demand was affected, you realize that the economies had to suffer. There would be a there was a low level of demand. Everything was not easy. When we talk of pandemics, I would still draw your attention to the recent pandemic that we have had, that's COVID 19. You saw how that devastated most economies in the world. Economies suffered, people lost lives, businesses collapsed, uh, most millions of people lost their jobs. So at the end of the day, we are saying when we put all these errors combined, cause what we call economic crisis. So here we are talking about financial crisis of 27, 28. So the global financial crisis refers to the period of extreme stress in the global financial market and banking systems between mid 2007 and early 2009. This crisis began with the subprime mortgage crisis in the United States in the 2007, which later spread to Europe and to Asia and to the rest of the world. The crisis led to the decrease in export earnings and economic growth, as well as in remittances from citizens working abroad and foreign direct investments. Poverty reduction was also slowed or even reversed. So we are saying this great global financial crisis began in the US, and it began with the housing, what was from what we call the housing bubble. Uh, the housing prices in the US were increasing, and as a result, uh, people started speculating. People anticipated that the prices would continue rising. eh, And this prompted most of the people in the US to. So we are saying that due to the expectations of housing prices to continue rising, uh, it led households in the United States, especially, to borrow imprudently to purchase and build houses. So, in a similar expectation on the house prices, also led the property developers to purchase to the property developers outside USA. For example, in European countries such as Iceland, Ireland, Spain, and some countries in Eastern Europe, to borrow excessively. So at the end of the day, many of the mortgage loans, especially in the United States, were for amounts close or even way above the purchase price of the house. A large share of such risky borrowing was done by investors seeking to make short-term profits by flipping houses and by subprime borrowers who have higher default risks, mainly because their income and wealth are relatively low and or they have missed loan repayments in the past. Uh, these loans at some point were nicknamed as ninja loans. Ninja loans simply means no income, no job, no assets, but you are going for a loan. So at the end of the day, the repayment of these loans are proved to be a hurdle. So what causes or what are some of the causes of this financial crisis of 2007 2008? So we are going to look at one, financial deregulation and policy errors. So we are saying the regulation of subprime lending or mortgage-backed securities was too lax or was relaxed. In particular, there was insufficient regulation of institutions that created and sold the complex and opaque mortgage-based or mortgage-backed securities to investors. So find the central banks and governments did not fully recognize the extent to which bad loans had been extended during the boom and in many ways in which mortgage losses were spreading through the financial system. So most of these loans were just being given. There was no regulation. There was no due diligence done while giving the loans. So this, at the end of the day, caused what we call the financial crisis, as the banks later would suffer and the economy at large. So the other cause uh, we are saying the housing market bubble. This is really related to the above point. Banks began to lend recklessly to families and individuals without true means to follow through on the mortgages they would be granted. Such high risk or subprime loans were then inevitably bundled together and passed down the line. As the subprime mortgages bundles grow in a number to overwhelming degree, with a large percentage moving to default. Lending institutions began to face financial difficulties. It led to the dismissal of financial conditions around the world during 2018-2009 period and continued for years that followed. So you find these loans were risky. People didn't have sources of income to repay these loans. So at the end of the day, the financial institutions began facing a lot of financial challenges. Recovery became a challenge. Uh, Again, I told you these loans were referred to as ninja loans, which means no income, no job, no asset. So the borrowers were just borrowing imprudently without any source of income to repay the loans. So we are saying weak financial markets and the institutions as well as unstable political economy. This is still the same. So when the financial markets are weak, financial markets and institutions are weak. It means uh, first of all, they did not follow the right procedures when giving out these loans. You know, if you need a loan, there is always due diligence. Your creditworthiness is supposed to to be checked. So at the end of the day, uh, these people lacked all this, and they just went ahead to give out the loans without understanding if the borrowers would really pay them back or not. So excessive risk taking or subprime loans, this is still the same. We are saying most both the households and the financial institutions were taking higher risk by getting or giving these loans. The households were taking the loans at a risk, even when they knew they wouldn't be able to pay. But their aim was to own a house. And you know, at the end of the day, because there was a boom in the demand of in the housing market, it means even the prices of the houses were high. So many you would have to borrow huge sums of money to buy a house, as we talked about, as we mentioned above, that some of these loans were far above the market prices of the houses. So this risky loans or subprime loans at the end of the day led to the financial crisis of 2007, 2008. Increased borrowing by banks and investors. So at the end of the day, the banks themselves, also due to the competition to lend, the banks also went to borrow so as to extend loans to the households who in turn needed to buy houses. And investors such as house developers also continue the borrowing so as to develop more houses to meet the competing demand. So at the end of the day, all these errors put together contributed to what we call the great financial crisis of 2007 2008. So what are the channels through which this crisis spread to developing countries or LDCs? So we are saying the financial inflows or linkages in the global financial system. So you realize that uh, most of these countries in Africa rely on foreign earnings say, let us say tourism, let us say, um, so we are saying, for example, let us say, here when we talked of banks, uh, you realize that as we discussed above, that foreign banks were active participants in the U.S. housing market during the boom, including purchasing of the mortgage-backed securities with short-term U.S. dollar funding. So I find U.S. banks also had substantial operations in other countries. So these interconnections provided a channel for the problem in the operation, for the problem in the housing market to spill over to other financial systems and economies in other countries. So we are talking of trade between the countries. So if a country is trading with an economy or another country which is affected by economic crisis, you do realize that that country gets affected highly. For example, in the Ugandan case, we were affected. Our coffee and fish exports were affected since we were heavily relying on the US and the UK markets. So our coffee was affected. Our coffee exports were was affected, and the fish exports were also affected. So if you are trading with a country which is affected, it means the demand for what you export would reduce because people are facing hardships in such economy. So you don't expect them to demand, especially if you are exporting a product or a commodity with an inelastic income demand. So you know all what income elasticity means. So you realize it responds with the demand responds to income. When incomes reduce, it means also the demand of certain commodities have to fall. So at the end of the day, that effect becomes a channel through which other countries were affected, especially the low developing countries. We are talking of the terms of trade shocks. You realize sometimes you are forced to devalue your currency. So some of these shocks at the end of the day became channels or the links through which the crisis spread to low developing countries. Remittances, you understand, most of developing countries rely on remittances from their people who are doing chayo or who are working abroad. So for example, if your worker, if your people are migrated and working in the countries which are heavily affected by the economic crisis, it means they cannot they cannot remit. So the fall in these remittances also means the effect now links the crisis that is happening elsewhere to the developing country because remittances have to fall uh, due to the exogenous shocks that are happening elsewhere. FDI and equity investments, you know, most of developing countries rely on the foreign direct investments. So if a country is affected by economic crisis, it means investors investors cannot uh, be able to invest in low developing countries because they are facing a challenge back at home. They cannot extend their investments to other countries. At the end of the day, this becomes a channel through which the LDCs get affected. Foreign aid cuts, most of these developing countries, of course, Uganda inclusive, rely on foreign aid. So, if a donor country is affected by economic crisis, it means they would not be able to remit their aid or to give assistance to developing countries, or in case they are to give, it means it will have to be reduced. So, at the end of the day, this becomes a channel through which this crisis is spread to the low developing countries. Say other offshore flows as a result of capital adequacy ratios of development finance. So uh, most of our developing countries rely on development finance institutions that give developing development loans, that give development assistance. So at the end of the day, if there is economic crisis in uh, a developed country, uh, it, it results to the reduction or even the stoppage of this official flows or these financial grants that development financial institutions offer to developing countries. So at the end of the day, this becomes a channel through which the crisis spreads to these countries. We are saying which countries are mostly at risk of getting affected. So we are saying countries with significant export to crisis affected countries. Again, if your exports are mainly targeting the countries that are affected by the crisis, it means you are going to be affected also. The crisis eventually has to affect such a country. As I mentioned earlier, that Uganda was affected. Uganda's coffee and fish exports were affected because we were heavily relying on the US and the UK markets to export our coffee and the fish. Countries exporting products whose prices are affected or products with high income elasticities. Again, we talked about, you say, if you are exporting goods or products whose prices are affected or by income elasticities of demand, you realize that if there is a fall in income in the countries affected by the crisis, it also means that they will not be demanding your exports. So the fall in incomes in a crisis-affected country directly means a fall in the demand of your imports or your exports to such a country. So countries dependent on remittances. So those countries that depend mostly on remittances by their people who are employed abroad are at a higher risk. Countries heavily dependent on FDI and development finance institutions. So if mostly like developing countries, we heavily depend on FDIs. So, for example, when we look at our economy here in Uganda, most of the big investments here are foreign based. Uh, uh, from foreigners. We talk of the telecommunication industry. We talk of the oil industry, the Dell of this world, the MTN of this world, uh, the Airtels. So you realize most of these are foreign direct investments that we have in the country. So such countries which depend on foreign direct investment and the development finance institutions who are mostly at risk because if bigger economies are affected by economic crisis, it means these people cannot extend their investments to other countries or to low developing countries. Just same as development finance institutions, if there is an economic crisis, they might find it a bit challenging to offer financial assistance to certain countries. So we are saying countries with sophisticated stock markets and banking sectors with weakly regulated markets for securities. Um, Countries with high current account deficit with the pressure on exchange rates and inflation are also likely to be at risk. Countries with high government deficits, weak fiscal policy are unable to pursue desired goals. So, again, you see, uh, if your government has a higher government deficit to finance it is desired targets, it means you mainly rely on foreign aid or foreign assistance. So at the end of the day, if there's an economic crisis affecting the donor countries and development financial institutions, say maybe IMF and World Bank, say you are likely to be affected. So we are saying such countries with the government or budget deficits or weak fiscal position. Weak fiscal position means your taxes cannot finance your budgets, or your revenue, what you generate, does not cannot meet uh, what you need to spend in an economy. So such countries will be affected, or they will be at risk. Countries dependent on aid, most of our countries here, Uganda inclusive, depend on aid from developed countries. So such countries are at risk because when there is a economic crisis in a country, say US, UK, the aid has to either be reduced or stopped altogether because they are facing a hardship, so they might not be able to offer aid. So I say such countries will get are at risk or will be affected. So I was saying impacts of global economic crisis on developing countries. So here we are saying it leads to a decline in economic growth. Uh, you know, most of the things we have talked about, most of the factors in general, it lead to the decline in economic growth because you have no remittances coming through. Development finance is not being granted to you. Uh, you realize the no aid is coming through. Uh, Consumer demand is low. Real businesses are collapsing. So we are saying all this put together lead to a decline in economic growth in an economy. So decline in exports, uh, as you know, if the economies you export to are affected by crisis, it means they will not need your exports anymore. So that means, or if they need, they will need in lower quantity because the demand is low. So when the demand is low, you cannot keep exporting when there is no demand. So we are saying that leads to a decline in exports. Reduced foreign investment inflows, as still discussed above. You see that the FDIs will find no reason to come and invest in developing countries because they are facing a shock, they are facing a crisis back at home. So they are unable to come and invest in the developing countries. And yet, for us, most of our big investments are foreign direct investments. So at the end of the day, we are saying this impacts developing countries negatively. Volatility of developing countries, stock markets, our stock markets are so volatile, they are unsustainable. So at the end of the day, uh, uh, this global economic crisis affects the developing countries negatively. So, for example, you look at uh, our currencies. You find is you might need to devalue. So at the end of the day, it has a negative impact on the developing countries. We say a foreign aid, as still discussed, we are just repeating these things. Uh, Foreign aid will have to be reduced, much as there is a significant evidence that most during this time of the crisis, foreign aid continued coming through to developing countries. But at some point, we would also realize that there was a reduction of foreign aid in developing countries. Uh, Donors cut on their aid. For example, Uganda faced a reduction or if not even a stoppage of the aid from the Irish government during that time. Uh, Distribution influence among developing countries, you realize that uh, the influence among developing countries gets affected negatively because generally African countries are weaker, or let us say developing countries. So the influence in the global economy gets curtailed. So we are saying weaker remittances. Again, we are saying when the workers the workers who are engaged in labor supply in these economies that are affected by the crisis may not be able to make remittances back home. So we are saying that impacts the developing countries negatively. You are talking of poverty. At the end of the day, if when we look at all the factors we are seeing above, uh, it is clear for us to understand that the economic crises lead to poverty in developing countries. We cannot get aid, we cannot get financial development finance support. Our exports, we cannot export enough. eh. We cannot have foreign aid investment, which means low levels of employment in the country. So at the end of the day, no income. or a reduction in real per capita income. So this means people will have to be poor. Health and education is negatively affected. This is very clear when when everything is not working well. We don't have money coming through in the economy. You find our hospitals cannot equip, cannot get good medicine. So all this means we are negatively affected as developing countries. Mm. General policy framework is affected. Pressure on current accounts and balance of payments. So as you say, basically you are asked to devalue, eh, you are asked to keep afloat. So that affects us developing countries. Lower investment and growth, as seen above, you will realize that people don't have money. If there is no money, there is no investment, there are no foreign direct coming, meaning even growth is not realized. Low employment or lost employment. So you realize still we talked of we don't have when there is no investment, no foreign direct investment in the country. It means there is unemployment, low consumption. If there is low consumption, businesses are collapsing. So at the end of the day, you know, we lost employment. So we are saying some policy measures of which mostly there is basically uh, fiscal and monetary policies that help in correcting some of these crises. So we are saying fiscal and monetary policy to boost domestic demand and exchange rate policy to bring about external adjustment. So fiscal and monetary policy, we are talking about to say cutting taxes, giving subsidies, eh, government increasing its expenditure so as to boost domestic demand in an economy. So improvement on the exchange rates to improve balance of payments. So we are saying governments or countries should try to improve on their exchange rates so as to improve on the balance of payments. Allow exchange rates to be determined by the market so that to depreciate if demand for foreign exchange exceeds supply. So we are again saying that allow the factors of demand and supply to determine the exchange rates. Okay, so that in case there is too much supply or mean too much demand for foreign exchange, uh, the exchange rates would be allowed to depreciate automatically so as to create a balance. So governments will adopt more expansionary fiscal stance that the way the case in the past fiscal year. Okay, here basically I think maybe it's an oversight, so it's just a repetition of the above. But here maybe I tried to. So we said government should adopt a more expansionary fiscal stance than the way the case in the past fiscal year, provided that any increase in government domestic borrowing can be accommodated without crowding out the private sector credit. An understanding of whether and how developing countries financial contagion or this is basically the possibility of spread of economic crisis or boom across countries need to understand the social outcomes and provide appropriate social protection schemes. So aid volumes and composition need to be re-evaluated. Should aid be provided to high-risk countries and in what form? So we are asking a question, should developed countries continue to provide aid during a downturn? If yes, why? So here we are saying yes. So to promote development in the developing countries, um, example, poverty reduction, you know very well, yeah, low developing countries or developing countries are faced with the rise of poverty. So we are saying these countries should continue giving aid so as to promote development in development developing countries. So we're saying to promote global public goods. So promoting global public goods here, basically we are the public goods such as we are talking about roads, for example. So to promote these global public goods, I find we are saying developed countries should continue to provide aid during the downturn, so that developing countries should also survive. To promote self-interest of the donor country, of course, you know most of these donor countries have self-interests. So at the end of the day, even if they have a downturn, they will continue giving out aid so as to promote self-interests. So also help partner countries address broad growth and poverty reduction challenges. So we are saying the developed countries should continue to advance aid to partner countries so that they are able to address the economic growth and poverty reduction challenges, overcome long-term constraints and make their economies more resilient with this diversified sources of growth. So we are saying these countries or these developed countries should continue giving aid even at the time of a downturn to developing countries so as to enable them to overcome the long-term constraints and that help them make their economies more resilient with diversified sources of growth. Mhm. So uh, now we want to talk about the Asian financial crisis of the late 1990s. So what was this crisis? We are saying Asian financial crisis was a major global financial crisis that destabilized the Asian economy and then the world economy at the end of the 1990s. It began in the Thailand following the Thai baht's devaluation in the mid 1997 and then quickly spread to the neighboring economies, causing a severe economic crisis. The countries that were most severely affected by the Asian financial crisis included Indonesia, Thailand, Malaysia, South Korea, and the Philippines. So, what caused the Asian financial crisis of the 1990s? So, there are mainly a few, there are many factors, but we are going to look at the main ones, which are Macroeconomic weaknesses. So we are saying the distinguishing feature of the Asian crisis is the lack of widespread macroeconomic problems prior to the crisis. So we realize while the capital inflows to Asia surged in the 1990s, most of the economies in the question managed to avoid substantial exchange rate appreciation that have often been associated with large capital inflows, particularly in Latin America. So the combination of the tight fiscal policy and monetary policies aimed at sterilizing the monetary impact of these inflows. The general avoided large appreciation against the US dollar. The impact of these inflows, the general, the impact of this inflows, general avoided large appreciation against the dollar. The main currency against which they pledged their exchange rates. Policies of pledging largely to the relatively strong dollar did, however, lead to some appreciation against the yen of some of these countries. So we said movement in the real exchange rate relative to the trend are of course in imperfect measures of real exchange rate overvaluation. So you do realize some of these were macroeconomic weaknesses. Then there's domestic financial vulnerabilities. So you say that this Asian crisis, the Asian crisis, this the Asian crisis countries experienced tremendous capital inflows in 1990s, ranging from about 3% of GDP in Korea to about 10% in Malaysia on a sustained basis. Most of these capital inflows and the associated investment moves were intermediate zone through weak domestic financial institutions that were often undercapitalized and poorly regulated. So you realize that the long periods of macroeconomic stability and high growth led to complacency on the part of the foreign creditor, banks, borrowers, and authorities. So liberalization of the domestic financial markets was not accompanied by appropriate supervision and regulation of financial institutions. Um, so we realize that caused the financial crisis in Asia or in the 1990s. So the next would be external vulnerability. So this is actually just the counterpart of domestic financial fragility or vulnerability in some countries. So several countries, notably Korea, Indonesia, and Thailand, and to some extent the Philippines, built up high levels of short-term external debt relative to reserves. So, so you find external vulnerabilities. This were a bit many because there is excessive build-up of short-term external debt. There's the run-up in external borrowing was also a response to authorities in some countries to the worsening situation in 1996. Mm. So the next would be change in external environment. In so if I, in addition to their own vulnerabilities, and in some countries, the dynamics of deteriorating macroeconomic and financial situation. Some countries suffered external shocks prior to the crisis. Perhaps the major development in the external environment that helped uh, create the conditions for the crisis of 1997 was the surge of capital inflows in the 1990s. As discussed above, you will realize that uh, some aspects of the external situation began to turn negative for some of the crisis countries, helping precipitate the crisis. So some of these external factors that reduced export growth, uh, uh, what are the sources of this Asian crisis. So, so you will also realize that the ongoing banking and the financial problems in Japan may have led to a slowdown in capital outflows from Japan to other Asian countries. So we are saying now if we put all this together, all these errors and so forth, contributed to what we call the Asian financial crisis of the 1990s. Uh, what are the effects of this crisis? So we find currency exchange, stock markets, and price of other assets all plunged or fall or fell. The GDPs of the affected countries fell by double digits from 1996 to 1997. The nominal GDP per capita dropped by 43.2% in Indonesia, 21.2% in Thailand, 19% in Malaysia, 18.5% in South Korea, and 12.5% in the Philippines. Hong Kong, mainland China, Singapore, and Japan were also affected, but less significantly. So, Asian financial crisis also resulted in political repercussions. International investment or international investors became less willing to invest in and lend to developing countries not only in Asia but in other areas of the world. Oil prices also fell due to the crisis. As a result, some major mergers and acquisitions in the oil industry took place to achieve economies of scale. So we are saying what are some of the policy responses. So one of the policy responses should be the external finance. So we find the most severely affected countries were Thailand, Korea, and Indonesia, and they experienced what we call external liquidity crisis, as investors came to doubt that inadequate reserves were available to service maturing foreign debts. As this doubt became widespread, panic set in. The adequacy of reserves, of course, depends on capital inflows themselves, but for this three, a bad equilibrium was possible in which investors believing other investors would fully. So when they believed that other investors would flee, they conclude that there were not enough reserves possible. So, so we are saying external finance. So, meaning these economies were basically okay or had to seek external finance to finance some of these their internal investments or their internal challenges. So financial structure reforms, the problem that lay at the heart of the crisis in most of these countries were weaknesses in the financial and corporate sectors. The shock of the decline in investor confidence, collapses in the exchange rate, increase in the interest rates, and decline in the sectors in deep financial distress. Meaning, so we are saying the shock of a decline in investor confidence, the collapses in the exchange rate, increase in the interest rates, and the declines in the real activity magnified in the initial weaknesses and left large elements of financial and corporate sectors in deep financial distress. So, at the end of the day, the policy is to reform the financial sector in the other one is monetary policy. Uh, you all know what this really have to do. So you have to realize that there was a tight monetary policy in Asia, and the evidence that that policy was in fact tight is surprisingly hard to come by. Uh, so at the end of the day, we are saying that we would employ expansionary monetary policy where government would invest in or increase government spending. Monetary, I mean governance, uh, there was need to improve on the governance of, and the other one is fiscal policy. That means cut or reduction in taxes so as to boost the demand. So lastly, we are saying which lessons did we learn from the Asian crisis? Many of the lessons of the Asian financial crisis remain relevant today. First, be aware of asset bubbles as they have a habit of bursting. Another was that governments need to control spending and pursue prudent economic development policies. Many countries learned from the financial crisis that many countries learned from the financial crisis was to build up their foreign exchange reserves to hedge against external shocks. Many Asian countries weakened their currencies and adjusted economic structures to create a current account surplus. The surplus can boost their foreign exchange reserves. The Asian financial crisis also raised concerns about the role that government should play in the market. Supporters of neoliberalism promote free market capitalism. They consider the crisis a result of government intervention and crony capitalization. The conditions that IMF set within their structural adjustment packages also aimed to weaken the relationship between the government and capital market in the affected countries and thus promote the neoliberal model. Thank you for listening to me. You be blessed.